there's one segment of this sector that I think is particularly on fire. It's the pharma biotech. Not all of them, but a lot of them got so oversold. You think about the Celgenes, the Allergans of the world. And Scott, I feel like we talked about this a couple of months ago, and we said at the time, late summer in a midterm election cycle is when you want to buy these, because that's when the maximum vitriol about pricing has gone on. We've already seen that with Trump and Pfizer backing off on pricing. These things got so beaten down that some of them, Mylan, Allergan, Celgene, were trading almost at book value. I mean, that's just unheard of.
Let me give you some of the returns since you mentioned those names.
Yeah.
Celgene's up 15% in a month.
Love it.
Pfizer's up 10. Allergan's up 10, Lilly's up 15, Biogen 18, Gilead 9, J&J, Cigna. Go down the list, Joe. A lot of these stocks have run.
They check all the boxes in from a portfolio management construction that provides you the diversification that you're looking for away from technology.
Is it too late?
No, absolutely not. And I think this is the perfect time. I think, again, from the diversification standpoint, it's the right thing to do. When you're looking at the overall weighting of technology, we all know it's 26%. Second highest sector is healthcare. So you're going to be able to get significant exposure on a PE basis. It's relatively cheap compared to financials, compared to technology. Oh, also, by the way, there's really no concerns as it relates to the trade irritant that we have going on right now in tariffs, and you're seeing consumers continuing to spend. So it checks all the boxes. I'll add ISRG to that. I think ISRG, Abbott Labs, which I own. Yesterday, I bought PKI. I think having healthcare exposure is an incredibly important thing to have here.
That stock's up 19% in a month. So, Michael, I mean, this leads to then the obvious question if FANG or big tech is going to have some sort of falter for a bit, and you're looking for something to pick up the slack. We've talked about financials and we've talked about energy. Maybe the place to look is the place that's worked over the last month, and that's healthcare.
So I think what
big
you're
enough
saying,
to carry you.
It's a risk-off kind of a trade, right? And it has been. It's been the more defensive trade, and I think that the big cap names have done really well. The Johnson & Johnsons of the world have done really well. The Abbott Labs. I mean, those kind of companies with really nice dividends provide pretty good, safe places to hide. I think, too, we've got to kind of remember that the value index and the value stocks in 2017 really underperformed the growth stocks by almost 1,000 basis points. That's still kind of happening. They just haven't taken off. They're doing a little bit better. They're showing some signs of life. But I think if you get out of some of those tech names, you want to be a little more defensive. You almost have to out of some of them because you look at an Apple at $1 trillion just to manage the risk in your portfolio, not time the markets. Hit them where they ain't, take a little off the table, put them in some of these safer names. Makes sense.
You've been making some moves in some of these names, and what do you think about the space as a whole? It's certainly not getting as many headlines as it probably deserves because, as we said, these glamour stocks take up so much of the air in the room.
Yeah, I agree with that. Definitely not as crowded as technology, particularly the FANG stocks, plus Apple, plus others that are there, Microsoft. So it gets less attention. Consumers are less, I would say, familiar with the actual product names and so forth, so less attention from that standpoint, too. But I agree with what both these guys said, with everybody, and kudos to you, Jim, for your expression for buying Celgene. I've been looking at it. I've meant to buy it. I will buy it. It's still extremely cheap. Amgen's making a new high. Much to everybody's chagrin, that's been very volatile. But in terms of what Michael said, in terms of what Joe said, they're defensive, true, but I also think they're offensive given where their valuations are, and you can get involved. And it's a good point in the cycle. We're hitting the longest bull market in history. So do you really want to
you're going to hit that literally on August 22nd.
Right. So do you
will be the longest bull market in history.
Right. And I don't think there's much there to derail it. So do you really want to take a chance and go with these uber-valued stocks at this point? Some have great business models. When your downside's protected here by Celgene, for example, with great earnings, Allergan had a great quarter. 2 activists we've talked about.
Regeneron yesterday.
Regeneron's been another good one.
It's not going to be without bumps, though, because the president every so often comes around and starts attacking the pharmaceuticals. He wants to bring those prices down. When the president starts tweeting, these guys hit some bumps. But overall, it's
what's good about
Pfizer folded. Pfizer folded like a tent.
Right.
On that
one day.
And that was unusual. But
it did.
And then it recovered. But what's good about his tweets?
No, I'm not talking about the stock. I'm talking about the company with its pricing.
Absolutely.
The stock's still up 10% in a month.
Absolutely. Yeah. But you know what's good about those tweets? he desensitizes the market to
That's
them.
exactly right.
But the frequency of them.
Let's
So by the way,
also think of
trade,
healthcare, not
today.
just as defensive. Let's think of healthcare as growth. Let's think of defensive beyond Pfizer. Let's think of managed care. Let's think of hospitals, which now that Medicare and Medicaid rates are set for 2019, names like HCA Holdings, Community Health, those are going to work for you. Let's think beyond just that. Let's look at medical devices. Congress is talking about offering some tax relief for the medical devices names. Again, Boston Scientific, working really well so far.
I'm going to chug the Red Bull before we began, but
I've been patient.
Just ease into it a little bit. You're up. Go ahead.
Thank you. Listen, here's where we differ, though. On those names, look, what we were talking about with the pharma and biotech, those are solidly valued. When you're looking at book value and dividend yields, the problem, and I'm not so much disagreeing with you, you just got to categorize it, right? The healthcare names, the hospital names, you called them growth, okay? But the valuations and the price returns on those sectors of healthcare don't have that same beaten down value characteristics that the biotech and pharma sector has right now. So I just think you have to make that distinction.